I'm Michael Broccolini. Work for Broccolini. I'm a third generation family member. I oversee our investments, the CIO, and our development team. I'm president of real estate at Broccolini. We're a family run business. We're focused on industrial and residential development, predominantly in Montreal, Ottawa, and Toronto. I think the biggest thing is we look at the fundamentals of the market, look at the trends that we are forecasting to happen. So right now in the market, we're seeing pressures on a lack of housing supply. So we're trying to pencil apartment yields that make sense for development. And on the industrial side, we're seeing the opposite effect, where we're seeing vacancy creep up. We're seeing pressures on rents to decline. And so our focus there is obviously, instead of building out spec in an uncomfortable market, we're really focused more on design build opportunities to take out vacancy or absorption risk. Yeah, I think today, with how much volatility and risk and uncertainty there is, I think spreads need to increase to take into consideration the extra risk. So what we're doing is, when we do our underwriting, all of our underwriting assumptions are conservative. So if our rental rate assumptions need to be a little bit more conservative, we'll do that. If our absorption period needs to be more conservative, we'll do that. And then if our cap rate assumptions need to be more conservative, we'll do that. So the actual underwriting, there's no aggressive underwriting assumptions. Everything is on the conservative side. And the biggest risk that we've seen over the last couple of years in terms of the most volatility is interest rate movements. All of our underwriting right now, we're taking out interest rate risk through either swaps or swaptions. Common pitfall, that's a good question. You can't control timing. And even though you think you have a short timeline and things can't possibly change that quickly, well, they did. And when they do change, and they change as much as it did, it really hurts. So I just touched upon it earlier, but the biggest thing we can do to protect that downside is locking in interest rate risk. That's the fundamentals of what we do, that's what gives you conviction. So if you have negative absorption quarter over quarter and rents start to decline, that gives us no conviction to move ahead on a spec project. And then the inverse is true. If vacancy is declining and rents are growing, that gives you the conviction you need to put the shovels in the ground. Biggest challenges, I think, is there's still today a bit of a pricing gap in terms of what vendor expectations are and what buyers' needs are. I think that gap has closed a lot in 2024. I think that's going to get a little bit easier in 2025. So that's a bit of a challenge and an opportunity. In terms of opportunities, I think we have a major housing shortage in Canada, and it's going to be even more so in 3-4 years, because there's been very little condo development in the big Canadian markets over the last couple of years. So I think there's going to be tremendous pressure on rental rates in 3, 4, 5 years from now. And if you're able to get into the ground next year and deliver in 2-3 years from now, I think you'll have tremendous upside.